Welcome to the MUFG Global Markets Podcast. I'm John Cook, and I'm joined today by George Goncalves, MUFG's Head of U.S. Macro Strategy. It's Tuesday, February 13th, 2024. Welcome back to the podcast, George.
Great to be back as always.
Yeah, good to have you. So, George, as you know, this episode is being recorded the day before Valentine's Day, which has really turned out to be anything other than sweet. Stocks are down, 100 points or 2%. The yen is getting creamed. It's approaching the Q4 lows, close to, 151. Treasuries are sharply lower. And really, even before today, duration has been tough to love in light of the hawkish Fed speak and resilient economic data. What's your take?
Yeah, no, it's been a very difficult market to kind of trade and navigate. I think this is part and parcel, though, for the lead up to where we got to. I think, again, it's important to realize this has been a 3-month environment, a little bit more than a 3-month environment, where we saw the 10-year Treasury basically hit 5% in October, and that was the high water mark. And then from that point forward, with less Treasury supply, the Fed over the course of Q4 starting to pivot and just kind of this animal spirits and just basically risk on for 3 months in a row. And we're kind of due for this sort of adjustment. And I think that the latest inflation data it could be one of the catalysts, but nonetheless, we have been kind of progressing up till this moment. Remember, we had nearly almost 7 cuts priced in. Now I think going on 4. The lead into this moment really started, I think, 2 weeks ago after the Fed meeting, which ended up being hawkish. Then we had the stronger than expected NFP, which we've kind of dissected and gone through. It wasn't as strong on the surface, and we can get to that in a second. But by and large, still much stronger than people were anticipating. And we've had a number of Fed speakers push back that they're in no rush to start an easing cycle. And then you had the now infamous 60-minute Chair Powell kind of focusing on that their job is to continue to keep inflation in check, and that they need more confidence in getting to a place where they can start an easing cycle. And all of that was hawkish. It ultimately resulted in our view change from expecting a March cut to now May, and even that could potentially be in question considering what's going on with the data. But for now, we're keeping a May as a starting point. But it really comes down to can the Fed get confidence after seeing a hotter than expected CPI report, although the Fed does not target CPI, and we know that PCE is their real mandate, and that's what they look at. And there are differences between CPI and PCE that are noteworthy. But nonetheless, today's CPI report was pretty broad-based in the sense of higher inflation in a lot of the subcategories. There's some concerns that we have around what's really going on with the owner's equivalent rent, and if that was just a one-off factor that led to the big bump up in core, and then super core had a number of things also driving to what was one of the largest monthly prints in over a year. So I think these are all just rude reminders, or just rude awakening, rude reminders that markets were pricing in perfection around the Goldilocks soft landing outcome, and it's going to get bumpy. I mean, the inflation is not linear, and data sets are going to be going in different directions as we try to figure out what is a more stable and sustainable growth environment. And I think this is just kind of really, where we got to a point where markets were due for some sort of kind of just a reset and a reminder that it's just not straight and up and to the right.
Yeah, it's certainly really anything but. You went through some of this, but a lot has really changed in the last few weeks. And as you say, perhaps we are overdue for some level setting as Goldilocks after all, is just a fairy tale. Not to put words in your mouth, but I suspect you wouldn't go so far as to say that a soft landing is not possible. But it certainly does not sound like your base case expectation, given the framework that you've laid out, here and elsewhere. Um, in some of your recent pieces, as well as in meetings with clients, you pointed out that the high frequency data is actually pretty mixed. The employment report, in my view, is a great example of that. You've got blockbuster payroll growth, solid average hourly earnings against like shockingly weak work week, if I recall, sort of as bad as it was in the pandemic. And then the household survey, showing an increase in a decrease in employment and an increase in unemployment. Yeah, great example, as I said. Why don't you take our listeners through some of the macro divergences that are most notable to you and perhaps most important?
No, absolutely, John. And I think you touched on one that we've been flagging for quite some time, the household versus the establishment and survey differences. And that even there's a pretty big gap between the total number of jobs created versus one index versus the other. I mean, depending on your starting point, it could be like close to 2 to 3 million job difference, which is obviously a big number. And even just lately, why the unemployment rate has not gone up has been largely because participation rate has gone down. Which again, that's not a healthy. Those are the kind of divergences you don't want to see. You want to see a broadening out of the labor force. So the jobs data has a lot of cracks under the surface that are diverging within each other's kind of like sandbox. But even if you kind of zoom out, um, one thing that we posted recently, which is out there for public consumption on LinkedIn, we put out one of our favorite charts around cyclical versus non-cyclical job trends, and the spread between the GDP and GDI. And headline economic figures have been solid. In GDP, for the second half of last year, much higher than potential. The recent uptick in job growth for the 2 months, look great on the surface, but we think are not really telling the true health of the U.S. economy and how sustainable is it without additional easing efforts. So we went back and looked at this two data sets, the cyclical jobs, which are everything ex government, healthcare, and education, and then compared that time series relative to the other subgroup, which is the non-cyclical, which is the government and education and healthcare jobs. And if you take the year-on-year growth of those two and then you spread them, you get another data set metric to observe. And we're not at the point where it's a major red flag, but it's turned amber. I mean, we haven't seen the cyclical job growth turn negative yet, but the wedge between the cyclical and non-cyclical has gotten as bad as it usually gets right before recessions. And that kind of also matched up nicely, or just ironically, or just kind of in the same time frame as the spread between GDP and GDI, which historically should track each other. I mean, growth is either sourced from income and or extra debt spending. And so uh, GDI, being gross domestic income, should not deviate that far off from gross domestic product and consumption. And so that means that consumption, if GDP was that strong, consumption was being kind of subsidized by credit, both from the consumer side, taking on additional credit, and government spending. And so, I mean, of course, these things can last longer in the short term, but the question is, how sustainable is it over the medium term to long term over the course of the balance of this year into next year, especially with an election year? So when you look at these things, you kind of start to put them in parallel. It's another one of those examples where we are seeing macro divergences, and the headlines look better than what really is happening on the ground. And I think that also probably is what's feeding into kind of consumer confidence and the sort of breakdowns that we're seeing there now, given we've had stocks up until recently having an amazing run, pretty much full employment economy, and consumers are still not as happy as they've been in the past, right? So I do think that all these things are just kind of picking up on the underlying signals that the economy hasn't really gotten back in sync with the way it should be growing. And we'll see what happens for us. Bringing this back to the markets, this is why every so often, whenever we do get these reminders that things are not all hunky dory and there's something going on underneath the surface, markets, once they get these reminders, they have these episodic vol moments and cause a lot of disruption, like we're seeing today, after the CPI print. So I think these are just things to kind of be mindful of, that this is going to be a year where it's not going to be linear. The idea of just straight to a Goldilocks soft landing and no bumps along the way is not our view. Our view that we could get there if the Fed actually eases and does it in the right way and tries to also address what's going on with the banking system and lending and the overall CREs, which is a whole other topic. But yeah, I think this is still a challenging year, and the data is really showing it.
Yeah, it sure is. If today's print is anything is any bit of foreshadowing, we'll be in for a wild ride. So George, you mentioned a couple things. I would like to just highlight for our listeners that chart you're citing is figure 4 in the January U.S. macro to markets outlook. I would also like to point our listeners towards George's recently published February 2024 Fed call update, pushing our first cut to May from March 2024. And if you are still not receiving George's strategy reports, there is another way to get them. Check out the new MUFG research portal at www.mufgresearch.com, where you can sign up to receive all of your favorite MUFG research. Great stuff as always. Thanks for coming on the podcast, George.
Thanks for having me, John.
Thank you for listening to the MUFG Global Markets Podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts. And reach out to your MUFG sales rep for any further information. Check back soon for more insights from the Global Markets Research Team.